Hi, everybody. It's Jeff Barton, and thanks very much for tuning in. This is the Mortgage Minute. We talk a lot about what's going on in the mortgage market as well as what's happening worldwide and around in the economy. The Fed, as everybody knows, has raised rates by a quarter point, probably looking for another 5 or 6. Read an interesting article today just about how the Fed has done this before and how basically best laid plans, right? Didn't quite work out the way they thought, and this may not either, just depending on what happens with the war, depending on what happens with inflation, depending on what happens with oil prices. There's a lot of things going on here, but we should see an improvement in inflation probably in about a year. However, 7 to 10% until that time. We saw not the consumer price index, but the producer price index went up 10% from this time last year, and that's a big number. Obviously, if producing prices go up, the consuming prices also have to go up. There are a number of things that we talked about in the last time I was on the show, just about why prices are what they are. But in this particular case, they are what they are because the prices are exactly moving up, and they're moving up in such a way that affects many, many different products in many, many different ways. So it's not necessarily a conspiracy by corporations to raise prices per se, although there are pockets, and I would go to say if we're seeing oil at $130 a barrel drop down to $90 a barrel, and we still see escalating prices at the pump, there's some disconnect there because in the reverse, prices go up pretty darn quick. Anyway, let's get to some of the mortgage rates for today. 4.5% mortgage rates have gone up, 3.88 for the 15-year, 4% for the FHA, 3.95 for the jumbo, and 3.82 for the 5/1 ARM. The 10-year is at 2.212, and the 2 years at 1.936. So we don't see the crossover of the 2 and the 10, i.e. the inflationary signals that would indicate are not there. And we actually are seeing what they call a steepening of the yield curve, meaning that number is getting further and further apart, which is a good thing because I think the economy needs to continue to grow in order to make people, want to get back to work and do some other things. Omicron 2 or whatever the heck that new one is called, that's coming, and we probably will see a resurgence of COVID. Who knows? And we don't know exactly what that'll mean. But the stimulus package that had been in place is no longer. We're also seeing mortgage-backed securities as well as treasuries. That buy ends this month, and we also are going to see the balance sheet, the $7 trillion balance sheet that the Fed has, also begin to unwind. Now, whether they end up selling or whether they end up just rolling the bonds off by paying them off as they come due, I'm not quite sure, but we'll have to wait for that. In the rate comparison, hey, listen to these comparisons. The rates are up, right? More than a quarter point this week, more than a percentage point from the lowest levels in March, almost 7/8 of a point since February, 1.25% so far in 2002, and almost 1.75% from the lows of last summer. That's a big increase. Now, has it affected housing at all? Not really. We have seen mortgage applications actually remain about what they have been for the past several months. Purchases are obviously up, which is offsetting the drop or decline in refinances. We have a decline in refinances of about 50%, but mortgage applications in particular are really remaining pretty strong. Let's see. Rents are rising 4 times faster than in 2020. Jobless claims are at 214,000, down from an estimated 220,000. The economy is still running pretty good. The balancing act between what the Fed is doing with the economy, i.e. raising rates or offloading the balance sheet and ending the stimulus package versus the growth in what we expect to have or have happen in order to have the economy grow. This is the balancing act that the Fed is trying to find the mix of. The war, obviously not shaving for the solidarity with the Ukrainians. It's a horrible thing going on there, and I hope it ends quick. Anyway, I'm Jeff Barton, your voice in the mortgage industry. We'll see you next time.